Hello everyone, good morning and welcome to this webinar number 5 on financing instruments for impact, developed by Católica-Lisbon in partnership with the European Investment Bank Institute. My name is Filipe Santos, many of you know me. I'm the Chair Professor of Social Entrepreneurship at Católica-Lisbon, and it's a pleasure to be here today with you to discuss about financing instruments for impact. An area that I'm very passionate about and very engaged with in the last few years. Just a note that since my last webinar, about 2 months ago, I became Dean of my school of Católica-Lisbon. So now I also have responsibilities in financing my school. So I'm both teaching about and practicing financing. I would like this to be also an interactive seminar. You may have different questions about financing, and so at some points in time I'll ask for your questions. You can write your questions, or if you want you can speak your questions in your voice. Okay? Very good. So let's get started, and I see already some familiar faces. We have some regular attendees to the seminars, so welcome everyone. My goal for today is to provide an overview of different sources and instruments for financing impact-oriented projects, organizations, or initiatives. So as long as there's some element of impact in your goals, and as long as there's some element of innovation in your approach, you are doing something which is slightly different from what normally exists, then I would like to, independent of having a for-profit or a non-profit or no organization, I would like to address your issues in financing. I will use mostly the model of the life cycle of your initiative to discuss what financing should come at different points in the stage. I'll also speak a bit about the business model and what kind of financing goes with different business models. And also in terms of the way that you want to disseminate your social innovation. At the end of the seminar, we'll speak a bit about that. But the overarching framework to discuss financing is to understand what kind of financing is needed or appropriate at different stages of your life cycle. And for the life cycle, I'll use this model that you already kind of seen before, probably, if you took my courses before. Which is basically a model of 4 stages in which the entrepreneur innovates on a new solution to a societal problem, then tries to develop a business and an impact model, starts growing and replicating the initiative, and eventually finds a strategy to disseminate the innovation. Of course, the challenge is that what seems an easy linear path is actually all but it. It's actually very hard to go through this process. And as many of you know, we mostly struggle in the middle stages. Once the excitement of the entrepreneurial ideas is over and the harsh reality of managing the day-to-day, starting to validate things and scaling sets in, everything becomes more difficult. So a lot of the financing is there to support you at this middle stage of development of your initiative. So I would like to go a bit in detail into the different stages and what they require. And I would like you ideally to be able to identify at what stage your initiative is in, because based on that stage, there will be certain instruments for financing which will be more appropriate. So that you can address this dead valley of growth. As you'll see, these are some of the instruments that I would like to discuss. It's a lot to discuss in a 1-hour webinar. So I'll focus mostly in what I think is a bit newer in terms of instruments. So I would like to go a bit deeper on the issue of crowdfunding, on the issue of social impact bonds, on the issue of equity impact investing. But I would like also to touch about the trends that I see in these different instruments. So I'll be available for questions about any of these types of sources or instruments. But what I would like you to do as a first exercise is to think for your initiative at which stage, first to fourth stage, at which stage you are in. And let me describe a bit each of the stages. So I hope you can see in your screen this slide. And the first stage is where the entrepreneur, the social entrepreneur, passionate about a problem, is trying to understand the problem, is trying to understand the issues that the beneficiaries or users face around that societal issue, is trying to come up and combine different ideas into an innovative solution, a product, a service, or a combination, chooses a specific target to start working with, children of a certain age or in a certain situation, or elderly people in a certain condition, and they develop this solution and try to validate it. There is a growing commitment of the entrepreneurs and the team committing to focus on this innovation, usually not full-time, but with a very passionate engagement with innovation. At this stage, typically, people will get small donations from stakeholders interested in the project, other individuals, foundations, municipalities at the local level of government. They may try to do some crowdfunding campaigns to get started and also to engage the interest of the audience about the issue and about the solution they are trying to validate. I will discuss much more about crowdfunding because I think it's becoming increasingly relevant as a way, as a mechanism for fundraising. And they rely a lot on the commitment of the 4Fs, the founders that commit sometimes for free and their own resources to the initiative, their friends and family networks, and fools, these good-hearted fools that like you and like your initiative. So this is, I would say, the initial stage. At the second stage is when you identified a solution that you believe will address the issue, and now you are trying to validate and perfect that solution. And you have to validate and perfect it in two dimensions. One dimension is the impact model. Am I generating impact? What metrics am I following? What is my theory of change? Meaning, what does my product create in terms of change in the beneficiaries over the medium long term? At the same time, considering the business model. How can I provide this in continuity? Who is paying for it? Am I paying because I have very low cost and use volunteers, or because someone is buying my product, or the beneficiaries can pay, or the government can pay? What's my business model? At this stage, you also want to see an increasing commitment of the entrepreneur and the core team. If you don't have at least one person full-time committed to the project, I don't believe you can progress at this stage because this requires hard work and a lot of commitment. At this stage, I see three potentially interesting sources of financing, in addition to the ones that I discussed before, that you could still potentially use. One is venture philanthropy, which is more strategic use of donations, lending, or investing, with still a philanthropic, lower than market returns kind of goals, but that commit to your project over the medium term. They give you 2 years of funding, they give you 3 years of funding, they may have some milestones in terms of the impact that you achieve, and usually foundations and some funds are increasingly active in this space, and that's a topic that I will focus on later. You also have this growing segment of impact angels, which are individuals that are really impact-oriented. They want to do good things in a sustainable way in society, and they are relatively wealthy, and they're willing to support entrepreneurs that have this impact and business mindset. One thing that I see growing a lot and being very interesting for entrepreneurs is the idea of impact awards. So increasingly, foundations especially, and companies, instead of just giving donations or grants to certain projects ad hoc, what they do is that they create a competition, they create an award, and then they select a jury of independent people. I'm part of 4 or 5 of these juries of national and international awards. And they try to create some criteria and some selectivity in the people that they select for awards. So the awards are becoming bigger and more strategic. I would say many, typical in Portugal, you would have BPI that has this type of awards, a bit EDP as well with their Social Innovation Awards. You have now Caixa creating a new type of awards. Internationally, I was just in the jury of a foundation, a Belgian foundation called the Groove Peter Camp Foundation that gave an award of €1 million to one selected social enterprise in Belgium around the issues of employment. I was also a jury member of Tom Hilfiger Awards for Social Innovation, where they gave large awards around €100,000 to 3 social enterprises around the issue of fashion that they could partner with after the awards. So many companies, many foundations are creating these awards, sometimes more generic, sometimes more specialized into a specific domain. The Chivas Venture Awards is another global award by Chivas that gives selects one project per country. So I see many of these, and it provides a good opportunity for you if you have a compelling innovation to position in an award that's related to your field of work. This also gives you not only money, which is important at this stage, but more important, gives you recognition, legitimacy as an entrepreneur, and also gives you the potential for partnership with a large corporation or a large foundation, which has immense value at this stage of development. As you move through and start validating your impact and your business model, you will get some external validation. The model works economically. Maybe you did an impact measurement study to validate the impact, and now you have a social innovation. And your challenge is now to grow and develop further that social innovation, and you enter into stage 3. And stage 3 is very much a management-oriented step where you need to codify your key processes that lead to business outcomes and to impact. You need to develop these key partnerships that support your growth. You need to define your model of growth, and we discussed this in an earlier seminar. If it's more organic, creating subsidiaries, if it's more franchising, like we saw in an earlier seminar in the case of Speak, is it building a network of affiliate members that we will join and adopt the solution? So you need to define your model of growth, and then you need to implement the plan. So this is a difficult stage because you move from being an entrepreneur to being a manager of a growing initiative. And there's 2 specific, the amount of funding required for all of these investments starts to be in the hundreds of thousands and not the dozens of thousands. So you typically see 2 types of funding that are relatively new in the last 5 years, which are around social impact bonds and equity impact investing. I would like to touch upon both of these later in the webinar. But social impact bonds are about you get paid for the impact outcomes that you achieve, and usually get paid by the government in areas of public policy. In equity impact investing, if you have a commercially based business model that generates revenue directly, you can get an investor that supports you for the potential growth and even profits of your innovation if you are more on the for-profit side. So I'd say social impact bonds are specifically to deal with areas of public policy, mostly if you are a non-profit, but not only. Equity impact investing if you are on the for-profit, more market-oriented side. And then you have the dissemination stage, where your social innovation gets some recognition, gets some key partnerships, and now what you want is to disseminate it further into society, into public policy, into corporate policy, into social sector adoption. And then you have either public commissioning, where the state commissions specific, not only outcomes like before, but since you validate your intervention, they actually start paying your costs, or you leverage corporate partnerships at scale, dealing with multinationals, or you start generating some debt, raising funds to fund the scaling because you can generate predictable revenues. So banks can give you some loans, or you can sell, if you are larger size, you can sell some bonds meaning some customized loans, and there are some loan programs that are social oriented, where they need to invest part of the money to lend in social impact organizations. And there is a growing market in these areas of bonds. So now I would like to take maybe 1 minute of your time, and I would like you to think in which stage do you feel you are in? And you can say, I'm in stage 1, or I'm in stage 3, or you can say, I'm in 2 to 3, or 1 to 2, or 3 to 4. Okay, so you can be in a transition, which creates its own challenges, or you can be squarely in the middle of the stage. So think about a bit about which stage you are in. That also shapes how you think about your own financing or funding opportunities. Okay, and if you want, in the chat box, just write numbers 1, 3, or 1 to 2, or 2 or 3 to 4, so that I can see mostly where you are, and I'll also adjust my discussion based on your feedback. Okay. So we are now seeing some people 1 to 2, 2 to 3, 3, 1, 2, 3, 2 to 3, 3, 3. Okay, so a lot of people in the growth stage, that's good. Or moving to the growth stage. You already got feedback from about 9 people. Stage 2. The Dead Valley, says Pablo from Formidable. It feels lonely in the Dead Valley, especially when you are in the bottom. The good news is that when you are in the bottom of the Dead Valley is when it feels most miserable, but when things are about to pick up and start to improve. It's like in economic crisis, when people are really, really depressed and when things are really, really down, that's exactly the time when they start to pick up, because everyone that was negative is already negative. So now things will start to face a corner. So that's economic cycles work like that. When everyone is very optimistic, it's time to run away. When everyone is very pessimistic, it's time to enter the market and start investing. Okay, so I see that most people are probably, except with a couple of exceptions, most people feel either in the second or third stage, or in between the second and third. I will speak about crowdfunding in the beginning a little bit, but maybe faster than I thought, to go to the issues more affecting people in the second and third stage around venture philanthropy, a bit about equity impact investing, and maybe later, if we have time, social impact bonds. But I also want to give you time, at least 15 minutes at the end for your questions. Okay? So thank you for your feedback. So the other thing to have in mind is the alignment between your impact and business model. If you generate revenues from your impact generation, or if those are separate. When those are separate, you are doing more traditional CSR, you have a business, and with some of the profits of the business, you invest for impact. Or you have a charity that has some side revenue generation activities, maybe fundraising or other things, or run a small business. So that's where we have no alignment. It's difficult to be investable in terms of social impact bonds or equity investment. You may be more in terms of donations or crowdfunding, or maybe impact awards for the impact of what you're generating. Sometimes people are more in the blended mode. You found a way of generating revenues from some of your activities. Your partner pays, your beneficiaries pay a component, a specific strategic partner can cover some of the costs. And then you can be, you don't cover full cost, but you are covering a substantial part of your costs. So strategic partnerships with corporations or venture philanthropy are ideal if you are in this type of alignment between impact and business. And finally, when you find a lockstep, when you generate impact from your social impact, from your business activities, like in Nuru Energy, you sell renewable lamps to people in Africa to provide access to light, and you make money for the selling and the recharging of those units. Or in the case of Speak, when people pay a fee to attend their language learning courses, and that fee is small, but because costs are very small in the way that you run the business, you can cover the full cost of your intervention. In those cases, you become investable, and you can deal with impact angels, with equity, crowdfunding, and with impact investing. So have in mind that in addition to the life cycle, your level of alignment between impact and business can shape the source of financing that you can cater to. So now let me go to just one note and then go to crowdfunding. In each country, there is now being created a market for fundraising opportunities. And in each country, there's usually a platform or several platforms, sometimes for profit, sometimes non-profit, that start to aggregate opportunities for financing. In Portugal, for example, that platform is called Geofundos, and you can subscribe. There's some free functionalities, there are some paid membership functionalities, and basically they collect all the funding opportunities and they provide them to you, depending on your sector, depending on your industry, and then you are aware of what's happening without having one person devoted to fundraising. So this is a service. I know the Portuguese version, but I would guess that in each country, it's likely to be similar aggregators, and I think it's really useful for you to join or to follow one of these aggregators so that you are aware of all of the opportunities, because now there are European awards, there are grants being launched by foundations that are increasingly international depending on their thematics or their domains. So there are many more opportunities than you imagine and you have access to. So these aggregators may be available for you. Now, I wanted to speak a bit about crowdfunding, because from a very small thing, crowdfunding is becoming a very relevant mechanism that I think has potential to develop further. So it's worth to spend about 10 minutes on this, but I'll be quite fast. Some of you already understand about crowdfunding. It's basically the use of digital platforms to raise typically small amounts of money from many people for specific and timed campaigns, for specific goals. There are different types of crowdfunding. There are campaigns where people get a reward for donating some money, and the reward can be, if you are a music band, you get like a download of the song or a CD, you can get the book, you can get a product. That's the original model of crowdfunding. It quickly evolved to, just a note that like the wake-up call for crowdfunding was in 2012, when in Kickstarter, one of the first platforms, this watch called the People Watch suddenly got 10 million euros to launch their new watch. So no one expected that a campaign could get this amount of money, but people just loved the idea of a smartwatch in the early days of smartwatches. And it was a hugely successful campaign that raised awareness to the potential of crowdfunding. And then it led, nowadays Kickstarter runs hundreds of thousands of campaigns per year, and it became a new marketing channel for innovative products. Based on this success, there was the emergence of this donation-based crowdfunding, where you can engage with the crowd on very interesting impact-oriented initiatives or campaigns, and can get money from many small supporters, and you can engage those small supporters with your project. And then there is a more commercial version, which is debt crowdfunding, where people exchange money with each other, or they lend money to companies, intermediating banks. This is the fastest growing sector of crowdfunding, as we'll see later, but it's probably not the most impact oriented, with a few exceptions. And then equity crowdfunding, where you can buy a piece of the ownership of an impact project. You can buy equity Seeders is the main platform in the UK, but with a global footprint, allowing to buy equity in small startups through the crowd. I've done a couple of investments in Seeders myself, and this works quite well. You don't have any work, and you invest in interesting projects and become an owner on those projects. So this is a way to democratize the idea of angel investing in projects. Just to give you, this data is slightly old, but just to give you a sense of the growth of crowdfunding, it's been growing almost exponentially. In 2015, was growing at about 100% per year, reached 35 billion. I think the growth has slowed to probably 30 to 40% per year. So now it's probably 100 billion market per year of amounts transacted in crowdfunding. We'll share all of these slides later. As you see, the biggest segment is lending. Also, the less impact-oriented is lending. But you see that donation, rewards, and equity, it's still a lot of money changing hands. In terms of geography, I would say North America is the biggest market by far. South America is small, Europe is growing, Asia is growing a lot. So Europe is still smaller compared to Asia or Americas, but I think developing very fast, especially I would say in Northern Europe. In the Netherlands, in UK, are where it's most developed compared to South Europe. Now, specifically crowdfunding for impact, which is what's interesting for us. I just wanted to highlight a few, in these 4 segments, there are different platforms and different impact-oriented mechanisms for financing. I identified one example from different countries that I know personally, but you probably will find a similar platform for your country. So one is the donations and rewards platforms. There's probably 2 or 3 in each country of Europe. This is the one for Portugal called PPL, where you can fundraise for all kinds of projects, adopting animals, creating artistic items, even the most recent success, the biggest campaign ever in this platform was, I'm not sure if this is impact or negative impact, but it was the nursing profession did a big strike in Portugal, and they fundraised their strike through this platform, and they raised about €500,000 from the crowd to subsidize the nurses that were on strike. So this could be probably seen as a negative impact crowdfunding campaign, but still just shows the power of these platforms when you create a campaign that really engages and communicates with people. Okay? I have participated in several campaigns. I have created campaigns. This really works for small amounts of money, 3,000, 5,000. You need a really visible kind of topic or innovative offering to go in Portugal to bigger amounts, but in other countries the amounts can go up to 10,000 or more. So this is very effective, but you need to kickstart this by leveraging your own network of supporters. It's a way to get your friends and family and supporters to easily give you money without asking them in person, and the money changes hands through the platform. But once you get some momentum, you could actually get a lot of anonymous donations and really developing your initiative. So this is one, they really help you in building up a campaign, they have like frequently asked questions on how to set up a campaign. All of these platforms, that's their business, they will help you create a campaign. So that's donations and rewards. Sometimes what big foundations do is that they create a match donation campaign. They say basically, I'm going to, I have 1 million of money to give. I want to give this money for people who get more money from the crowd. So I'm going to do a partnership with one of these websites. This was CrowdRise, for example. And I'm going to highlight 20 of my projects, and I will distribute my 1 million based on the amount of money they get from the crowd. And this is a way to engage, to leverage the money from the crowd with the money from the foundation. That's very effective, and projects in this campaign generated over 11 million euros. And this is another campaign from 2015, if I'm not mistaken, globally, from the Skoll Foundation. A more recent campaign that's similar is this Shiva's Venture Award. So they select a for-profit impact venture per country every year, and then they do a big kind of event globally where all of these pitch for a certain amount of money, and they do a fundraising campaign, and the crowd can participate and vote, and they match the money that gets generated. So this gives you a lot of visibility. This is an example of what I mentioned, impact awards. This gives you a lot of visibility, may give you some money, and if you are the winner, you can actually get hundreds of thousands. So this could be interesting. Code for All is a Portuguese initiative that was there last year. The winner in Portugal this year is Speak, that was featured in one of the earlier webinars. And there are basically 25, 30 winners from different countries competing for a big award. So more than the money, these awards give you really visibility and credibility for your venture. So this is on crowdfunding. There's also lending crowdfunding, lending for impact. Kiva is the most well-known, but Kiva is to lend by people like us for small entrepreneurs, usually in developing countries. But more interesting, they have grown quite large, but more interested is platforms like this. One Planet Crowd is a lending platform. This one is based in Netherlands, but there are similar to this in each country, where basically you can put your campaign to be supported by the crowd, especially around stage 2 or 3. So when you are stage 1 and maybe 2, you do more of a donation or reward-based crowdfunding. When you are stage 3, even 4, what you do is a lending crowdfunding campaign. And the lending, you basically say, I have this very visible product, I have this, like for example, a fair trade chocolate or this innovative solution. I want to grow internationally, and I want to raise 2 or 3 million. And I can actually generate revenues and pay back 5% per year, 7% per year, and I have some reliability in this income. So for example, 2 projects I know recently received 2.5 million euros in this platform through a loan, a long-term loan. So you can avoid the banks. The banks ask you for collateral, they have outdated risk assessment criteria, they're hard to deal with. This is a way to disintermediate banks, to go directly to the crowd for lending. And you can get, actually, if you have a visible brand, you can actually get a lot of money from this lending crowdfunding. So One Planet Crowd is the most well-known platform in the Netherlands. Works really well. There are similar platforms appearing in other European countries. And then there is equity crowdfunding, where you get money from the crowd, especially around stage 2 to 3, when you're starting to grow and you need 500,000, you need 700,000, you need more or than what typically you get in a reward crowdfunding or on a grant, but you don't want to go to banks because of the risk involved. And this allows for people to share the risk with you and invest in you. This is a platform that works really well in Spain, called La Bolsa Social. Some of the attendees, Formidable, got funding from La Bolsa Social, which is in the webinar. So basically what they do is that you apply to the managers of the platform, you post your investment case, your business plan, your impact criteria, they approve you, and once you get approved, you launch the campaign. And then if investors, these impact angels, they don't want to deal one-on-one with legal contracts, so they go to the platform to find interesting deals, and the platform manages everything, and they don't need to deal with any bureaucracies. They are sharing the risk. If this runs badly, they'll lose their money. If this runs well, they can make money or can support the growth of the project. So one of the initiatives in La Bolsa Social got sold for double money, I think a year after it was funded. So people who invested in it earn 100% in a year, which was good. Others have been growing and are developing. So this works quite well. There are small numbers here. Labo Social, I think, made 7 or 8 investments since its launch. It works really well. And there are similar platforms around equity investing through for impact in different countries. In France, there's a couple of platforms. So in your country, look for the platform both for lending and for impact. In large countries, France, Germany, Italy, Netherlands, UK, for sure, there's a platform right for you, depending if you want rewards or donation, earlier stage. If you want equity, usually stage 2 to 3, or if you want lending, which I would advise when you are much more established, have regular revenues, and they are moving from stage 3 to 4, okay? Right, so this was about crowdfunding. I wanted to speak a bit about a couple of other topics that are developing. One is impact investing, the other is social impact bonds, and the third is venture philanthropy. I probably go a bit faster now just to pick your interest on these topics, to then open up for your questions. Impact investing. As you know, when we speak about equity investing, so impact investing is typically about equity investing, like Labo Social that I mentioned, but it's not crowdfunding, it's not the crowd that invests, is a special partner that invests, either one angel or a fund that invests in you. Usually they invest for the long term, they assume the risk of the investment, and their profitability comes from either you being sold later or being IPO'd, or from the managers buying out the investors at a later stage. So this is commercial equity investing. I just wanted to give you a basic idea about you are basically selling a share of your capital. So this only works for profit. If you need, for example, 200,000 and your valuation before the investment is 600,000, once the money gets in, your valuation is 800,000, which means that you gave away 25% of the company to your investors because they gave 200 out of the 800 total value. So you give away equity and control of your venture to your investors. So usually this happens in rounds, around when you are early stage, around the later stages. So there's different segments, usually for riskier activities. And then you have 2 types of investors: individuals, impact angels, or more institutional funds. And actually we speak a lot about funds, this venture capital, but most action happens on individuals, on these angel investors, some of which are converting to impact angels. They are moving to the impact space because of their personal beliefs, their values. They want to really engage with impact projects. These are just numbers for commercial investing in the US, just to give you a sense of the numbers. But what's happening is that you now have, I would say, 3 segments. The small impact angels go through these crowdfunding platforms. They have no bureaucracy. They can put small amounts of money in different projects. It works really well for them. The more strategic angel investors go and invest directly into projects. So I've been investing through platforms, and I've done a couple of investments as an impact angel, just to also test the market and understand a bit of the process. The more institutional people that have bigger amounts of money, like foundations or companies, they usually put that money in a fund, a venture capital fund, and they invest indirectly through that fund. So we have these 3 segments: the crowdfunding platforms, the angels, and the funds. In terms of funds, just to give you an example, there was a fund in Portugal called Fundo Bem Comum, who was a normal venture capital fund that was trying to invest. Their investment strategy was to identify middle-aged, highly qualified people who became unemployed because of layoffs in banks or in large companies. but they were highly qualified and skilled. They wanted to develop a company, and so they needed financing for their company. So they started investing in them. So they had like a bit of a social component, but for a very specific niche. They didn't find really enough pipeline of deals. So a couple of years ago, we discussed with them and repositioned them into the impact space. And they did a couple of investments in the impact space. One was in Speak, which we discussed earlier. So basically what they did, so they said, okay, we are going to finance Speak. Part will be equity for a 30% share of the company. Part will be a loan, because if we took everything into equity, we would take too much of the equity. We didn't want to have majority, so they wanted only 30% of the shares. So they put part of the money in the loan at a low interest rate. And they would say, ideally, if the model becomes cash flow positive, part of the cash flow will start being paid out, and we will make money out of the cash flow payout. We get the loan back and make a small profit out of the dividend payout in the future. So that's their idea. They also invested in Code Academy, which is a venture that is training in digital skills unemployed people and children. And there, the valuation was a bit higher, so they put 200,000 in equity for a third of the share, and aimed for the managers buying out their share at 10% interest rate a few years later to help finance the deal. And then they also invested in Booking Loop, which is a recycling of used books, school books, a model, very scalable model, where they put 75% euros for equity of 25% share. So an example of how a small fund that had 1.25 million to invest, supported by a big set of players, found 3 impact deals to invest in. So this is an earlier stage impact investing fund in Portugal. In the last 5 years, this has really developed worldwide. So this is a very large impact investing firm in the area of micro-insurance and microfinance worldwide. They now manage about 1 billion euros in assets. They've done about maybe 15 investments, and the companies they invested in serve about 100 million people around the world. Examples of their investment, for example, in South Africa, they invest in a venture that was providing life insurance and health insurance to people infected with HIV. So HIV infection rate was very high in South Africa, and people had not only the problem of HIV, but the problem of lack of insurance to buy a house, to find a job, to run a small business, and that really excluded them from a normal career. And so this entrepreneur created a feasible way of providing insurance to HIV-infected people, and doing it at the profit, starting to be successful, but needed to grow. And this fund came in at an early stage, invested in them, helped them grow to a stage where they validated the business model and became so interesting that an insurance company bought them out afterwards, because they felt this was a new area of insurance they were neglecting. So this is the type of deals they invest in, is insurance for neglected segments of the population. It's micro insurance for farmers, things that have a lot of impact and that are being neglected by normal insurance companies. So this is a very successful fund. Another earlier stage impact investing fund, which I know very well, the founders, Henry Wigan and Alex Pitts, is this one called Mustard Seed. And Mustard Seed says, I'm going to invest in these lockstep models between impact and business, where the model generates revenues, but it's also perfectly aligned with the impact, so we can actually have our cake and eat it too, meaning we can have the best of both worlds. And they believe they can actually exceed the market returns at the same time that they demonstrate impact. They had initially a network of angel investors, and they were finding deals for those impact angels. And then they created their small fund of 5 million to co-invest alongside their impact angels in the UK. It went so well that they created a 30 million euros fund to fund directly the deals they were sourcing. They have about 15 investments. Now they are in partnership. They are creating a fund for Portugal, also a 40 million, and they're doing really well. I recommend that you go to their website and look at the portfolio of investments they've done, which is quite interesting in terms of having about 15 investments in this lockstep between business and impact. So to support this new sector of impact investing, there's new roles appearing. So there's these intermediary organizations that are creating a bridge between the social entrepreneurs and the impact investors, creating linking points, creating capacity building. MAIS is an example in Portugal. FASE is an example in Germany, the financing agency for social entrepreneurs. They do a really good job in intermediating these deals between what was before separate sides of the world in terms of investment and impact. You see accelerators focused on impact appearing that are trying to source impact-oriented deals, accelerating them for 3 months, and then funding them at the end of the acceleration period. You have also corporations or industries creating basically new think tanks or entities that identify impact-oriented projects in the area of fashion for good, based in the Netherlands, but with a global footprint. Is trying to look for innovations that will improve the fashion value chain. And you are now seeing different industry people coming together to fund these think tanks for impact. And then governments are becoming increasingly active. We helped the Portuguese government create the Social Innovation Fund in Portugal with the Portugal Social Innovation Initiative that basically matches all of these investments. Impact investings are matched by the government, creating an incentive for impact angels, for impact funds to come into the market because they get investment. Okay? So this is the more commercial side of the world. Of course, sometimes you don't have these lockstep impact models. You cannot provide market-based returns or close to market returns. So you have the world of venture philanthropy also to support you. And venture philanthropy is where kind of the venture capital meets philanthropy, is this idea of focusing on projects that are driven by their impact goals, but it's very patient capital that doesn't require high returns, doesn't require short time frames, and really focus on building the capacity of the organization. They could be an ideal partner for you in going from stage 2 to 3, potentially to 4, but essentially going through the dead valley. And you have some social investment funds that have this venture philanthropy mindset. FitTrust in France is the most well-known. SI2 in Belgium. You have Oltre Ventures in Italy. So in each country, again, there's usually 1 or 2 leading venture philanthropy funds. Large foundations like the Gulbenkian, SB Fairbairn in the UK, Italian foundations are starting to be active in venture philanthropy, doing more strategic grants long-term to support organizations. And then corporate foundations are creating programs of venture philanthropy where they also do this more strategic support. These I won't get into. I think it's maybe too complex for the time we have. It's about more hybrid instruments. I will leave them in the slides, but I don't want to go through these because this is only interested for a narrow set of projects. I would like to just spend maybe 5 minutes to discuss impact bonds and then move to your questions. When the market does not work for you, because you are not generating revenues from selling a product, but you are creating impact that can be converted into public policy benefits, especially being converted into cost savings for the government, you can use this idea of pay for outcomes. This is becoming increasingly popular from an idea that was new about 7 years ago. Now there's hundreds of impact bonds being funded across the world. And this looks complicated, but it's actually not that complicated. It's basically saying there are 1, 2, or 3 social organizations that have an intervention that generates benefits for beneficiaries. and they need to be funded to generate those benefits. How do we fund it? Because what they do is innovative, the government does not want to take the risk. So an investor comes in and says, I'm willing to take the risk because I believe in this. I will make a contract with either the social organization or with kind of a vehicle that will do the investment. I will set the targets that I want to see achieved, and I will manage this carefully so that you achieve those targets. And we'll make a contract with the state, the government, to pay for those outcomes. And we only pay when there is a successful outcome being achieved. So this has the advantage of transferring risk from the social organization or the government to the market, of being very clear about what are the outcome metrics that are relevant, being very closely managing the performance of the projects, and making sure there's value for money for the state. An example of where this was done was in Peterborough, where there was an intervention to 3,000 ex-inmates while they were in jail and living, short-term offenders that reoffend at a rate of 40%, and they wanted to lower the reoffense rate. So they worked for 3 years with the 3 cohorts of prisoners, 3 organizations joining their efforts to complement their intervention, private investors supporting all of these, and the government saying, if we hit a reduction in reoffending, we will pay out these bonds, we will return the money to the investors. So the target reduction was 10% per year. Overall 3 years, 7.5%. So first year, 8.4% reduction, below target. Second year, 9.7% reduction, slightly below target. But the results were so compelling that the government said, I like this model, I'm going to make this public policy. So actually the intervention was stopped at year 3 because the innovation was rolled out nationally. And so the project did not quite reach the targets, but succeeded in deploying a new social innovation widely and validating it, which was the goal. And the value for money is basically the idea of a societal problem has a cost to the public sector. The delivery of our innovative solution is lower than this cost, which allows to pay for an investor return and still have money for the public sector to make savings. And this is the case, the value for money for the government to get involved with. And the government usually likes to see this green part as big as possible, maybe covering 50% of the cost of the intervention. And usually this is the cost in 1 or 2 years. There are benefits that stay for the long term. So this could be a way to validate certain innovative models that cannot use the market because they deal with homeless people, they deal with elderly isolation issues, they deal with inmates. You cannot sell a product to them, doesn't make sense, but you can have an impact, you can generate a measurable outcome, and you can make the government pay for that outcome, and that validates your model. In the future, you turn it into a new, basically, public commissioning service. So these slides help you a little bit in thinking about how to set up one of these bonds. And this is kind of a step-by-step. I don't want to go into too much detail, but it's a step-by-step. You focus on the issue, the target population, what's your innovative intervention, can you do it alone or integrate other providers, what are the metrics that will measure, and then you do the costing, and then you implement these with all of the contracts. Okay? So this is really growing in terms of interest. There's already, I think, 5 social impact bonds in Portugal. There's about 200 worldwide. UK is the most developed market. US follows next. Netherlands is also growing strongly. And Portugal and across Europe, this is developing a lot. So basically, and I'll open up for questions now. We like to have about a 1 hour seminar and then about 15 minutes for questions. But basically, I wanted to bring you this idea of the life cycle for you to understand where you are in the life cycle and what are some of the opportunities for you to get funded along the life cycle, depending on where you are.
We spoke a lot about crowdfunding, equity impact investing, social impact bonds, impact angels, and a bit venture philanthropy and impact awards. So the things that are mostly at stage 2 and 3, where you are. But I'll be open for questions that you may have about any of what I've discussed, or any trends or any ideas that you want to share with the group. So let's open up for questions. Okay. So Pablo says it was a great experience raising funds through Labo Social. So that's good feedback. We have Francesca Passeni from the European Crowdfunding Network, which is basically an association that gathers all of these crowdfunding platforms around Europe. And I mentioned PPL and One Planet Crowd, which are part of their membership base and are among our best practices. She had to leave a bit earlier, but it would be great also to have from them also more updated data about the sector, because data is difficult to find and it's interesting to follow. Some compliments from Jimmy Antonson. Now questions. What question you may have about anything that I've said? Could you summarize some of the key values that will attract investors? Now, that question is a bit difficult because depending on the profile of investor, they will require different things. And because of that, I think more important for you is to understand and look for fit. Given where you are and what type of business model do you have, what profile of investor is the best fit with you and your needs. That's why I like the life cycle, and I like people to be very selective when they look for source of financing. Because even if you get money, if you get it from the wrong type of investor, wrong for you, you may get pushed in the wrong direction. So having said this, there are some things that everyone would like to see, no matter what stage that you are in. Of course, one thing is about talent and commitment of the entrepreneurs. People understand that without good entrepreneurs, without good leaders, nothing gets achieved. So no matter what stage you are in, for profit and profit, they want to see a committed entrepreneur, at least one person, but one person able to gather a team around him or her that is willing to commit full-time to the project. I think this idea after stage 1, this full-time commitment is what makes the difference between success and just kind of walking slowly and dying in the Death Valley. Is the fact that you commit, you bet your life and career in this working well, and that commitment brings confidence from your investors. So that, I would think it's a must. The other thing that is a must is that's not well practiced, is your focus on really understanding your theory of change, on measuring your impact carefully around a certain set of metrics. So understanding what you want to achieve in terms of impact. Not all projects do this well. That's really important for all types of investors. You have to do this in a social impact bond very carefully, but less with others. But the more you do, the better for you in terms of managing your project and the investors. The rest, I would say, it's more of a fit with the investors. Now, one question is if we can summarize a list of social impact investor funds at EU level. I think actually that's a great idea, and either other people are doing this, and we could reference these and point you to the right sources, or no one is doing this at European level, and we should do it. And so I think I can commit here in the context of the chair for social entrepreneurship. And I'll ask our chair manager, Denise, to work a bit on this, of collecting what are the lists and the sources of financing around this life cycle for different projects. So maybe from the European network of crowdfunding, we can get lists of crowdfunding platforms. From the EIB, from the EIF, we can get lists of the impact investing funds. So we'll try to collect lists and create a page in our website where this is compiled. We'll share with all of you and we'll make that available. So that's a commitment we do to you to have this in the next few weeks. There's a question, are green bonds social impact bonds? And the answer is no. So green bonds are basically lending products, usually for projects that are larger scale at later stages, where the projects have an environmental impact, and because they have an environmental impact, they are labeled as green bonds. They are piles of money that only want to be invested in these environmental projects. So social impact bonds are not formally bonds per se, they are impact contracts in which the government agrees to pay for certain outcomes. So they're actually not bonds. They're called bonds, but they should not be called bonds. In Portugal, we call them titles. We don't call them bonds. So a green bond is a way to lend money to finance an environmental project. There's also social bonds, for example, in France, and those are products. They're called the 90-10 bonds, where people put money in a large loan portfolio, like 100 million. Out of those 100 million, 90 million are invested normally, and 10 million are lent to social organizations and have to be lent to social organizations. So those are called social bonds or 90-10 bonds, and those are lending products. So don't get confused, this is very confusing. Green bonds are traditional lending products for environmental oriented projects specifically. Social impact bonds are outcome contracts, they're not bonds. And social bonds are lending products in which part of the money needs to be invested in social projects. Okay, so we got any additional questions? We have maybe a few minutes more for questions, if anyone is interested. We usually can run it up to 12:15 if you are still there and engaged. So any sharing, also if you have an experience that you'd like to share, you could also raise your voice and speak and say, I've done this type of financing, it went well, my learnings are this or that. So you could also have sharing of specific learnings that you believe would be valuable. We have 28 people in the webinar, so we have an audience that you could share your experience with. Anyone who would like to share? If yes, raise your hand, and the technicians will give you voice. So there's a question about, are there any problems in getting cross-border fundings? Is it best starting nationally? So the answer is yes. It's difficult to get cross-border financing. That's an area that I personally want to work with at the European level to promote more of a cross-border investment market, because it's very nationally based. I think the benefit of platforms like Seeders is that because the internet has no boundaries, I can be in Portugal and go to Seeders and finance a Belgian project. So through crowdfunding, cross-border borders become less relevant. But once you deal with the institutional investors, foundations doing venture philanthropy, funds doing impact investing, then nationality becomes a problem. What I think we will see is joint investments that are cross-border. For example, a Portuguese project wants to go to Italy and France, and they do a joint financing round with a Portuguese, a French, and an Italian funder to fund the growth plan. So that has happened already in Spain with a model dealing with autism and disability employment that moved to France and Italy. So I think we'll see more of those deals, but it's still an area to be developed. We need more work on cross-border investments. A question about, is there any suggestions for research for impact investing in sustainable foods? Here, I don't have any specific leads, but is there anyone that has an answer to this? Is there maybe people from Farmable, if Pablo is still there? Is there any suggestions for research for impact investing in sustainable food, for the team of sustainable foods? Pablo is thinking. Okay, any other? Does anyone want to raise their voice and share? There's always a lot of questions about financing. What's on your minds? Okay, very good. So if there's no questions, I will close the seminar in a couple of minutes. So the goal was really to be able to give you a sense of the landscape of financing opportunities. There is a lot of developments. So if I had done this webinar 2 years ago, the landscape would be much less complete than it is now. This is a market developing a lot. There's, I would say, at stage 4, there's an increasing role for companies to play in terms of corporate partnerships, strategic corporate partnerships. And there are now more mature products of lending that are being created. And the government is being also more eager to commission this type of innovative interventions. And so there is also developments there. But overall, there's a complex landscape, but really fertile and active landscape. A lot of people to help you go through the dead valley of growth of your projects. So I recommend that you get to the right intermediaries, the right platforms to get access to some of this information, because I've done, part of my life is to keep track of this, but it shouldn't be your life. Your life should be running your projects. So find help, people that can help you navigate this landscape and get support from these intermediaries. So that's one takeaway. The other is about fit. Not all financing opportunities are good for you. Identify, depending on your business model, what stage you are in and your goals, what's the right fit, and then go actively search for it and create matches. Don't go for the wrong investor for your venture, because you can get sidetracked into different directions, or it can actually create misalignment. So that's when I think fit is important. So just remember, when you are asking for money, we're not asking for a favor. You are giving an opportunity to the funder to get engaged in a very interesting, impactful project that works with ecstatic entrepreneurs. And for that benefit, they should be paying. Okay, so don't have a sense that you are asking for people to support you. You are engaging in a partnership that has 2 ways, and there's a value proposition for both sides. Okay, so understand what's the value proposition to the other side in both the emotional, credibility, and monetary rewards, and engage in it as a partnership. You are not asking for any favors. So that's on final words on financing. I'll skip that slide. And I would just say, stay tuned for the next webinars. We have this cycle of scaling impact and social innovation webinars supported by the IB Institute. So thank you for the IB team, if you are there, for the great support you do in this field. The next webinar will be 19th of March in the afternoon, 4 p.m. European time, 3 p.m. UK and Portugal time. And we'll discuss an interesting topic that I think you will enjoy, called learning from errors, learning from mistakes, from failures. And so we'll have a dialogue between Frederico Fezes Vital, who works with our chair in social entrepreneurship, has a social entrepreneur in residence, and has a lot of experience in these topics. He will work in a dialogue with a few people that have done good things, but also failed and made mistakes. So to discuss how can we learn from failures. So stay tuned for the next webinars. Thank you for your attention. We had 28 people throughout the webinar and 18. We have a hand in the air from Veronica. Yes, Veronica? I think you have the voice.
Can you hear me?
Yes. Yes, we can, Veronica. Hello.
Hello. Thank you so much. This is very enlightened, this webinar. I don't know if I have a question or if I want to share something. I'll just say it. If you, when you have a type of investor that wants to invest in you, but you are not sure if it's the right moment, or it's the right investor, not the person, because you really like the person and you say, and the person is connected with the project, but the kind of investment the person wants to make. I'll give you an example. An impact angel. He wants to invest in a profit organization, and you're not. You're a non-profit organization still, and there's a perspective of becoming a profit, but not yet. So, but the investor is so much willing to invest in you that how do you deal with this situation when you know that maybe you get there, but maybe it's not the time yet? You're not feeling prepared for that, or you know what I mean?
Yes, I think I understand the issues or debates that you are raising. So I think one thing I liked in what you said is the idea of fit. You like the person likes you, they likes the project, you could get along with the person. So sometimes you can get money from an investor, but you don't really align well with that investor, either emotionally or empathically, or you don't think they have the capabilities to support you. So in those cases, it's better to stay away, because some investors can be a pain in the neck, not to say another body part. So that connection is important. Now, the other thing is fit and alignment of goals. And so how patient can they be until they look for the profit that they would like to see in the future? So my suggestion is to put things in writing, because putting things in writing has two advantages. One, you really have to lay down what are the expectations on both sides and agree on something in writing. And so you can say, with this investing, we understand that we are not likely to see any revenue generation or any profits in the next 5 years. And we are willing to be patient capital, but we would like to see you move into profitability or a revenue-based model in this amount of time. So laying out those conditions will align. So either you are aligned and you find an agreement, or if you cannot agree on what to put on paper, that's a signal that you are not really aligned, and then you should not invest at this stage. The other advantage is that sometimes people agree with something in principle, but 3 or 4 years after, their recollection of what they agreed is different, and they'll have a different perception. No, I said I wanted you to be profitable sooner. So no, you told me that I could have 3 or 4 years. And then at that time, if you did not put it in writing, it's perception that counts. And sometimes if there's any sense of conflict, then things get a bit more confused. So my advantage or my suggestion is always put things in writing. It makes sure that people lay down their expectations on both sides and sets it into stone, in the sense that people cannot then reinterpret what they said 1 year or 2 years after. So if you can put in writing something with both are comfortable and happy to live in the next few years, then maybe have enough basis to move forward. If you cannot do it, then maybe it's not the right timing, and maybe they can support you in a different way. Maybe say, look, you are really excited about the project, why don't you give us a grant to start with, like a test, like this speaks to maybe I didn't want to get into details because this is quite detailed, like these types of hybrid models that I had here. But you could say, why don't you give us at this stage, for example, a convertible grant? It's a grant, we are at an early stage, But if we create a spin-off that's for profit, then your grant converts into an equity share of our spin-off company. Okay, so that's a way to say, look, this is a grant, you may lose it, but if this really becomes profitable, and if we really create a for-profit radio station for the world, for children, then you can get like a 5% share because you supported us in the early days. So these hybrid instruments are a way to deal with some of those special situations where you have a for-profit investor willing to be patient, but then they should invest with a mechanism that reflects that patience or that risk-taking. So I wrote down a bit what each of these type of instruments mean and how they are deployed. Some of them are really widely deployed. So on the bottom line, convertible loans are really widespread, and blended instruments like the SIB, social impact bond, are appearing. But the other parts, so the ones in circle are the basic things: grants, loans, and equity. The ones, the hybrid, are the boxes, the rectangles. Those, except for the 4, are less. The 1 to 6, except for the 4, are less deployed, but could be deployed in very customized deals with certain investors. Okay.
What are the amounts of money that are supposed to be recoverable?
I would say convertible grants, I typically see them in smaller amounts, around, for example, 50,000 euros. 20,000, 30,000, 50,000. It's almost a validation. Say, I don't know if you'll be successful, but you want to validate that you have a business model, you need some financing. So I'll give you 50,000 for like the next 2 years to really have some room to validate this. If this becomes successful, then you convert this grant into a piece of the equity. If it doesn't become successful, then it's lost, and we understand it's lost. So that's an example. So usually convertible grants are in the, I would say, in the tenth of thousands, are usually below 100,000, I would say.
Okay, thank you.
Okay, so we are now a bit over time. It's 12:20, so I don't want to abuse your patience. We still have 24 people, so more than at noon, so people are still coming in, which is good, and you are staying faithful. So I think this is a topic that is of high interest to you. So one thing I would ask you in the evaluation, if you'd like us to go deeper, so I could have spent 1 hour on each of the things I told you about, but I wanted to give this more of an overview. But if you'd like us to go deeper on specific instruments, tell us which instruments you'd like us to go deeper in your evaluation form, and I'll make sure that we'll find an expert on that instrument to really go deep with you in 1 hour on how to deploy this instrument. Okay? So thank you very much. Next webinar will be 19th of March in the afternoon. Stay tuned for our announcements. Great to see you, all of you. Good social innovation, good growth for your projects, and all the best. Bye-bye.